Welcome to Step to Wealth. Every day you see people having 4, 5, even six-figure trading days, trading options in the stock market. Of course, you would think, well, how can I make this money and how can I do it for myself? If you go on YouTube, there are countless hours worth of videos teaching people different strategies and analogies, trying to help you understand the basic concept of options. I have watched just about every video trying to explain what really are options, and none of them really gave me a full grasp of the concept. So here in this video, I will explain to you what an option is, why you would use it, and the potential return on your investment that can be acquired with the proper knowledge. According to Investopedia.com, over the last 25 years, the S&P 500 has returned 9.9% annually, or over a year. Meaning for every $100 you invested, by that next year, you would have made roughly $9.90. So for those of you who don't know what the S&P 500 is, all it is an index fund that consists of the top 500 US companies. But you may also not know what an index fund is. And all that is a portfolio of stocks that is used to mimic the overall performance of the stock market. So we said the stock market returns 9.9% annually every year, but obviously the market doesn't continually go up. There's years that it goes down and there's years that it goes up significantly. So for example, in 2022, the S&P lost 19.4%, but in 2019 it gained 31%. So let's take an example here. Let's say I bought 100 shares of Apple at a price of $150. So that would cost me $15,000 because my position size times the price of the stock, 100 times 150 would give me 15,000. Well, let's say around the time I bought my shares, the stock began to dip, and I needed a way to protect my position without selling it. I would buy an option. An option contract gives you the right, but not the obligation to buy or sell the underlying asset at an agreed upon price during a certain period or specific date. So let's break this down. I know your head's probably spinning. Mine was too the first time I heard this. So all an option is, it is giving you the right, but not the obligation. What it means by that is, think of the right, but not the obligation as setting a reservation for a restaurant. Let's say you want to go eat at 5:30. You have the right to go in at 5:30, but let's say something comes up and you can no longer go. If you have the obligation, meaning you have to do it. So meaning you would have to go to the restaurant at 5:30. But since you have the right, you can decide to go or you don't have to. Same thing with an option. You can sell it or you don't have to. You can exercise it or you don't have to. And then it says to buy or sell the underlying asset. All the underlying asset means is the stock at an agreed upon price is what we call the strike price during a certain period or specific date. And all that is the expiration date. So here's an analogy I like to use. I like to think option as insurance for stocks. So let's say I bought a Ferrari. The Ferrari, very expensive, but you want a way to protect your Ferrari. You would buy insurance. You don't always use your insurance, but when you do, it comes in handy. Same thing with the stock. I want to protect my position size in a stock. But the way I would protect that is with buying an option. I might not always exercise the option, but when I do, it'll come in handy. So we said an option contract. It isn't really a contract. It's all done virtually, so you don't have to trip over that. But before we move on to an example, there are two key factors I need you all to take note of and write down. So there are two types of option contracts. There is a call option and a put option. I'm going to explain a call option first. A call option gives you the right, but not the obligation to buy a stock at an agreed price during a certain period or specific date. So for a call option, we're betting the stock to go up. But for a put option is giving you the right, but not the obligation to sell a stock at an agreed price during a certain period or specific date. So we're betting on the stock to go down. So let's recap that. A call, you're betting on the stock to go up, which gives you the right to buy stock at a certain price. A put option is giving you the right to sell a stock at a certain price, meaning you are betting on the stock to go down. So to put this in context, I'm going to use an example. Let's say I bought 100 shares of Apple at a price of $150. Position size times the stock of the price That would give me 100 times 150 equals 15,000. But let's say I wanted to protect my position in Apple, so I would buy a put option, because the definition of a put is it's giving me the right to sell a stock at a certain price during a certain time. So because I bought a put, that means I am predicting the stock might go down. But let's assume for right now, the put option just costs $500. There are many factors that go into the price of an option, but that'll be covered in a later video down the line. So there are two scenarios. The first scenario, we're going to say the stock price rose to 160. Remember, we bought our shares at $150, but the price rose to $160, meaning the stock made a 10-point move or a $10 move. So we bought 100 shares down here, and it made a $10 move. So we're going to do our position size times the move in the stock would be 100 times 10, which would give us $1,000. So since your profit is $1,000, we have to remember we bought a put option for safety or as insurance. So we wouldn't walk away with $1,000. We would walk away with $500 because we had to take the put option subtracted by our profit margin from the stock moving. So you would think, oh, this is a ripoff. Why would I even need that? Something that I didn't even use. But you have to think, just like in real life, we have insurance, but we don't always use it. But when we do, it comes in handy. So for the second scenario, same situation. I bought 100 shares of Apple at $150, and I bought a put option for $500. Instead, we're going to assume this time that the price dropped from $150 to $125. Since it dropped $25 or 25 points, same formula, position size times the move in the stock, 100 times 25, that would give me $2,500. So right now, I'm down $2,500. But we have to remember, I bought a put option. And let's go back to the definition of a put option. The definition of a put option gives me the right, but not the obligation to sell a stock at a certain price. So let's assume the put option we bought was a $150 put over the next 30 days. So what that means is the definition of a put, sell at a certain price. That certain price would be $150, and over a certain amount of time would be the next 30 days. So meaning I could sell my Apple shares at $150 over any time over the next 30 days. So let's say currently the price is trading at $125. Let's say I wanted to exercise my put option. So therefore, I could sell all of my shares at $150. And remember, I bought all of my shares at $150. So basically, I would be at break even. Versus if I sold down here, I would be down $2,500. But let's remember, I bought 100 shares at 150, and I'm going to sell my shares at 150. So that would leave me at break even. But we have to remember that since we bought the put option itself, that would be our only loss. But which one sounds better to you? $2,500 or $500? So these are two scenarios in which playing a put option and the result that it would lead to. Now remember, there are two types of options, a put option and a call option. So calls would work the same way, just vice versa of the puts. Think the put you could sell at any point. In the calls, you're going to be allowed to buy at any point. So if throughout this video you have any type of questions, please put them in the comment section below. I will make sure to address them in the next video. No question is a dumb question here when learning something new. As well, if there's anything you would like me to address in future videos, please put in the comment section below so I can accommodate all of you guys' needs. Throughout this video, we constantly said that options are used as insurance. But instead of just trading outright shares, you can also trade the option contract itself, which in reality is you are just betting on the stock to go up or down. And you would ask, how would you do that? Well, you use price action and previous history of the market. That will be implemented in future videos because that's where I see the channel itself going to, kind of teaching you all how to trade options and teaching myself because trust me, I'm no master. I've only been in the game 6 months, but I just want to give some knowledge back to the community that I already have. So in the next video, we will address what an option contract looks like, where you can buy one, and how to decipher what type of contracts you should buy given a situation in the market. So if you are interested in signing up to start an account that can be used to trade, I highly, highly recommend Webull. It is an app in the App Store which allows you to trade all types of stocks, ETFs, and options. Good thing about Webull is they only have an initial deposit of $5 to activate your account versus other brokerages like TD Ameritrade that require a substantial amount of minimum deposit to activate your account. So in the description below is a link that will take you directly to Webull, and you can sign up from there. But please watch this before you sign up. If you are interested in starting an account now, just make sure to sign up for a cash account instead of a margin account. I can't stress this enough. If you sign up for a margin account instead of a cash, you will not be able to trade options as much as you would like versus with a cash account where you can trade as many times as you want. And then later in the process, when you're starting an account, I think there's a box that says, what would you like to trade? It says stocks, options, or ETFs. Make sure you select stocks and options, and you can select ETFs as well. But I selected ETFs just to have all the different type of markets. So everything looks good on my end. I'm glad to have you all here, and I will see you guys in the next video. Stay stealth to get to the wealth.